A big day shaping up tomorrow on the economic calendar with new home sales out in the morning. But the main event is Fed Chair Powell's speech at Jackson Hole at 10 a.m. Eastern Time, where investors will look for confirmation of a September rate cut. Joining us now is David Mericle. He is Goldman Sachs chief U.S. economist. David, good to have you here. I mean, it's probably not about if. Obviously, a lot of the data and the Fed's own framework and rhetoric have gotten us to this point where it seems like the logical thing is they will be previewing a change in policy toward the easing side. But I guess the question is, exactly how specific or how aggressive he might be in trying to lay out what that path looks like.
I agree with that. I think after yesterday's minutes, it seems that everybody on the committee is reasonably on board with a cut. The question is now 25 basis points or 50 basis points. I suspect what we'll get from Powell tomorrow is a more dovish version of the remarks that he gave after the July FOMC meeting. A little bit more dovish, a little more confident on inflation, a little bit more concerned about the labor market, because since July, we've had softer employment data and softer inflation data. I don't think he's going to answer the question for us of 25 versus 50, because that's a question that should really come down to the next employment report, the August report in early September. So if we hear from him something like what I just laid out, then, I would think it comes down to that August employment report. My best guess is that the August report will look better than the July report. And in that scenario, I would guess that we're on track for a 25 basis point cut in September. A dovish risk would be if he comes out and expresses more concern, more urgency about the downside risks to the labor market, or if he says that the level of the funds rate is simply inappropriately high at this point. Either of those kinds of comments would hint at a faster pace of cutting. A hawkish risk would be if he instead emphasizes that the stance of broad financial conditions is actually still pretty easy, which might imply that even if the funds rate is too high, it's not an urgent problem, so you don't need to address it as quickly.
Isn't the Fed's own work, its own projections, and really what Powell has said before, pretty clear on the idea that the Fed funds rate at its current level is quite restrictive and probably well above what neutral is, and certainly is well above where inflation has been coming in. So therefore, it would seem as if that wouldn't be a remarkable statement for him to say, we have room to cut to get anywhere toward neutral.
I agree with that. I suspect the Fed leadership agrees with that, but there has been a range of opinions on the FOMC. Some people have been more concerned about inflation, a little bit more reluctant to cut as a result. And, I think up until now, that range of views has probably held them back. My guess is that we're moving beyond that we have now had a long enough string of encouraging inflation data that the people who were more concerned will kind of move toward where the rest of the committee is and say, we are kind of over this problem and be more ready to cut. So I agree it wouldn't be remarkable if he said it. But maybe it would be a little bit of an evolution from where they are. I think, again, the bigger question is how much downside risk do they perceive in the labor market, and does that justify in their minds moving more aggressively? So far, comments from Fed officials since the July employment report suggest no, they're not yet thinking in terms of a 50 basis point cut. That in their minds, that seems to be a little bit more of a crisis type setting where you really need to solve a big problem quickly. And, I think they think fairly enough that we don't yet have a big problem. My guess is it's really the data more than Fed commentary that will resolve that.
Now, you mentioned you would expect that the September jobs report, for the month of August, is going to be a bit stronger than we saw last month, which would suggest, I guess, that there's not as much urgency. Now, you also think, though, in that context, the Fed could cut 3 times by a quarter point each by the end of the year, correct?
That's right. The original plan, if you look at the dot plot, seems to have been to cut once a quarter. And I would think of that as sort of a normalization path, where the only reason that you're cutting is to get back to a more neutral funds rate, not because you're trying to solve any urgent problem. I think since the July employment report, we now have an unemployment rate that is a little bit above where it was before the pandemic. Our jobs workers gap is a little bit below. So there's a little bit more of a motive creeping in to support the economy. So far, I think it's enough to kind of turn up the notch by one dial from quarterly cuts to consecutive 25 basis point cuts, at least at the outset. I don't think it's yet enough to crank up the notch by 2 dials all the way up to a 50 basis point cut.
And then just very quickly, where do you think ultimately they cut to?
We have them cutting to 3.25 to 3.5. You know, that's 200 basis points below where we are now, but it is 100 basis points above where the funds rate peaked last cycle. And a big part of the reason for that is that our longstanding House view here has been that neutral is not and never was quite as low as it was widely perceived to be last cycle.
Gotcha.